What if I told you that your bank account might be one of the worst places to keep your money right now? Most people park their cash in a traditional checking or savings account, earning next to nothing, sometimes 0.01% APY, while better options have been sitting right inside their brokerage accounts this whole time. Cash management accounts are quietly becoming one of the smartest financial moves you can make. Higher yields, higher FDIC protection, and features that in some cases beat what your bank offers entirely. But, and this is a big but, there's a risk almost nobody talks about that could seriously hurt you if you're not careful. Today, we're breaking down the four biggest names in the space: Fidelity, Schwab, Vanguard, and Wealthfront. By the end of this video, you'll know exactly which account is worth your money, which ones fall short, and what you need to watch out for before you make any moves. Let's get into it. Section 1. What are cash management accounts? Quick refresher before we dive in. A cash management account, or CMA, is essentially a hybrid between a checking and savings account, but offered by a brokerage firm instead of a traditional bank. Think of it as a spending and savings account that lives right alongside your investment accounts. Now, here's something important to understand. Even though more and more people are using CMAs like bank accounts, they are not bank accounts. So how does your money stay protected? Brokerages typically sweep your cash into what they call a partner bank network, a group of FDIC-insured banks that hold your money behind the scenes. Fidelity, for example, works with 19 partner banks, including names like Citi, BNY, US Bank, and Goldman Sachs. By spreading your money across multiple banks, brokerages can offer FDIC coverage well above the standard $250,000 individual limit. Some CMAs also give you the option to invest your cash into a money market fund instead, which is SIPC insured rather than FDIC insured, up to $500,000 in securities with a $250,000 sublimit for cash. All right, now let's walk through each account. Section 2, the comparison. Fidelity CMA currently pays 1.84% APY through their bank sweep program, with up to $4 million in FDIC coverage for individual accounts. But here's the thing, if you move your cash into Fidelity's government money market fund, SPACs, you're looking at a 7-day yield of around 3.32% right now. That's what we personally do, and it's a meaningful difference. There's also a potential tax bonus. In 2025, roughly 50.9% of SPACs dividends may be exempt from state income tax because of its U.S. government securities holdings. One caveat though, residents of California, Connecticut, and New York may not qualify for that exemption due to specific quarterly requirements those states impose. On the feature side, Fidelity CMA has no monthly fees, no minimums, a free debit card, unlimited ATM fee rebates worldwide, and no foreign transaction fees. That last part is actually why our family made Fidelity our go-to card when traveling in Europe. You also get check writing, online bill pay, and compatibility with Apple Pay, Google Pay, PayPal, and Venmo. The one gap, no Zelle. For some people, that's a deal breaker.
Schwab. Schwab is the odd one out here. It's the only firm in this group with an actual banking arm, so it offers a real checking account rather than a CMA. The features are actually great. No monthly fees, no minimums, free debit card, unlimited ATM fee rebates worldwide, no foreign transaction fees, check writing, bill pay, Apple Pay, Google Pay, PayPal, Venmo, and yes, Zelle. But then there's the yield, 0.01% APY. Basically nothing. And because it's a traditional checking account, there's no partner bank network for extended FDIC coverage and no money market fund sweep option. You're capped at the standard $250,000 FDIC limit. So great features, terrible yield. Keep that in mind. Vanguard. Vanguard calls theirs the Cash Plus account. The base yield through their bank sweep program is 3.1% APY, and right now there's a 0.25% APY boost running through April 30th, 2026, bringing the total to 3.35%. FDIC coverage goes up to $1.25 million for individual accounts through their partner bank network, which includes names like Citi, Wells Fargo, and American Express, plus a few less familiar banks. You can also put your cash into one of 5 Vanguard money market funds, with yields currently ranging from 1.84% to 3.64%, each with a $3,000 minimum. Personally, if I had $500,000 or less in this account, I'd go with VMRXX or VUSXX. Both are currently yielding above 3.6%, which beats the bank sweep rate even with the temporary boost. The tax advantages here are compelling. In 2025, about 69.58% of VMRXX dividends may have been state tax exempt. For VUSXX, that number was 100%, and importantly, that should qualify even for New York, California, and Connecticut residents. If you're in a higher tax bracket in those states, the municipal money market options like VFYXX or VCTXX might be worth looking at for full federal and state tax exemption. Now here's where Vanguard falls short, the features. There's no ATM card and no check writing. There's also a potential 60-day holding period on new funds and a 7-day hold on some transactions. The account is compatible with PayPal and Venmo, but not Apple Pay, Google Pay, or Zelle. And there's a 100,000 daily transaction limit. If you need this to function like a real checking account, Vanguard Cash Plus is going to frustrate you.
Wealthfront. Wealthfront's cash account pays 3.3% base APY with a 0.65% boost for new clients for the first 3 months on balances up to $150,000. The standout here is FDIC coverage, up to $8 million for individual accounts through their partner bank network, which includes major global institutions like HSBC, Morgan Stanley, and Wells Fargo. There's no money market fund option, and you need $1 to open the account, but no other standard monthly fees. You get a debit card and access to more than 19,000 free ATMs nationwide, plus reimbursement for up to 2 out-of-network ATM fees per month, capped at $7.50 each. Online bill pay is available, but no check writing. There are free wire transfers to title and escrow accounts you own at other institutions. Compatible with Apple Pay, Google Pay, PayPal, and Venmo, but like Fidelity, no Zelle.
All right, so which one wins? As always, this is personal. Everyone's situation is different. But if we had to pick one that works best for the widest range of people, we'd go with Fidelity CMA. The yield is solid when you use the SPAXX money market sweep. The features are strong: unlimited global ATM rebates, no foreign transaction fees, bill pay, check writing. It works well as both a spending and savings account, and it integrates seamlessly with your Fidelity brokerage and retirement accounts. Schwab is arguably just as strong on features and adds Zelle, but that 0.01% yield is just hard to justify when better alternatives exist. Vanguard offers the most compelling yields and tax advantages, especially for higher earners in high-tax states. But the lack of an ATM card, possible multi-week holds on funds, and limited payment integrations make it impractical as a primary spending account. Wealthfront wins if your top priority is maximum FDIC coverage or the highest headline APY for a short period. But those limited ATM reimbursements, just 2 per month, would be a deal breaker for us personally. The bottom line, none of these accounts are perfect, but they all do one thing really well. They connect smoothly to their respective investment platforms, making it fast and easy to move money between your CMA and your investment accounts. In that role, as a supplement to your brokerage accounts, all 4 work well. Section 4. What to watch out for. Now let's talk about the part most people skip, the risks. Even though we love our Fidelity CMA, we still keep a traditional bank account. Here's why. First, CMAs don't have physical branches. That sounds minor until you need something notarized, or you need to resolve a problem quickly with ID in hand. At a bank, you walk in and handle it. With a CMA, you're on hold. Second, there are a few recurring pain points our viewers bring up regularly. Longer hold times on certain deposits, especially checks or ETFs for newer accounts, accounts getting locked after large or unusual transfers, sometimes requiring multiple calls over several days to resolve, and integration issues with third-party billers, which can be genuinely disruptive if you rely on those. But the biggest risk, and this one really doesn't get discussed enough, is what happens if things go wrong at a systemic level. Think Lehman Brothers. Think Silicon Valley Bank. If there were a serious banking or brokerage crisis and you needed to quickly move money from your CMA to a traditional bank account, what would that look like? Could you log in? How long would a transfer take? What are the bottlenecks? Honestly, we don't know the answers to those questions, and that uncertainty is exactly why we don't keep our life savings in a CMA. These accounts are still relatively new and largely untested under real pressure. With a traditional bank account, you can walk to an ATM and get cash. With a CMA in a crisis, that playbook hasn't been written yet. So use these accounts. They're genuinely useful, but think carefully before relying on one exclusively.
All right, that's the full breakdown. Fidelity, Schwab, Vanguard, Wealthfront, all compared. Drop a comment and let us know. Are you using a CMA alongside your bank? Have you ditched your bank entirely? Or are you still on the fence? We'd love to hear from you. If you want to go deeper on any of these accounts, we've linked individual videos for each one below. And if you're interested in what to do with the cash sitting in these accounts, bonds, covered calls, preferred shares, and other income strategies, check out the link below to learn more about our private investment community. See you in the next one.